Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time, and this week's topic, guys, is the 4 pictures of power in trading. These are the 4 things that every trade has to have. A lot of them start with the higher time frame. So the 2 topics we're going to really talk about deeply today, guys, are you must always have a higher time frame bias, and then that bias will turn into a lower time frame entry. It's a 2-pronged approach, okay? So when you're scanning, you're looking for the higher time frame bias. We'll talk about what those 4 things are. And then once you have that higher time frame bias, then you're gonna drill down to the lower time frame and you're gonna get your entry point. You must have both of these things. You guys have to stop vacuum trading, okay? If you're not looking at the higher time frame, you're just, tunnel vision looking at the lower time frame, you're not going to have very successful trades. And the other thing we're going to talk about today, it's same topic, is can you combine some of those 4 pictures of power? We have 4 separate pictures of power, but what if we could get 2 or 3 or even all 4 of those pictures of power on the same higher time frame and then drill down to the lower time frame? So our goal as traders is what? To take the most reliable trades that we can possibly take so that we can make the most money because we'll be the most accurate. Well, that's what this lecture is going to help you do. Be a more accurate trader, which ultimately should translate into more profits. As always, guys, if you like these videos, please click that like button, hammer that subscribe button. We got to grow this account. You know what I mean? A lot of good stuff here. Don't forget those click notifications, which will help you get emails every time I upload a new video. I am Jared Wesley of Live Traders. Let's get to it. Today's lecture topic is the 4 pictures of power in trading. All right, the 4 pictures of power. There are a lot of things that we look for, guys, to try to be more accurate with our trading. And I sometimes, maybe occasionally, overstate the title of a topic and say, oh, this is one of the most important lectures that I've ever done. But this lecture actually, other than money management, is in a tremendously important topic. We talk frequently about gapping stocks, or we talk about relative strength and all those things, but why do we like certain stocks more than others? And pictures of power are the reasons we like some stocks more than others. And sometimes that picture of power is a gap, and sometimes that picture of power is relative strength. Well, we have 4 of those pictures of power that we're going to look at today. And we're not just going to look at the pictures of power on a higher time frame. We're going to drill down a little bit to the lower time frames and make sure that we're getting the entries on those higher time frame pictures of power. I know I'm not in presentation mode, Yarno. I'm well aware of it, but I'm not really honestly interested in messing around with it right now because we've had too many tech issues, and if it's working, I'm not touching it today. On a normal day, I would fix it. But anyway, so the pictures of power, guys, are the things that you are looking for when you're scanning in the morning or even after the market opens, what you're looking for. But it's not just, hey, look, there's a 5-minute 3-bar player. There's a 2-minute buy setup. No. There's so much work to be done before you get to a 5-minute buy setup or a 2-minute 3-bar player, any of that. And that's what we're going to talk about today. But before we do that, we have to get into when will the insanity stop? When will the insanity stop? Never. Honestly, the answer is never. We hope every week that doing these will put shame on so many people that we can shame them into doing the right thing, but that's never going to happen. So this week, I actually have 2 of these for you guys. I think they're interesting. I think they're really interesting, to be honest with you. Some weeks they're really fun in terms of the egregiousness of the insanity, and other weeks they're a little less egregious. But this week's is fun. All right. So the first one is, I think investing in the stock market is going to make me have about 10 personalities. Well, I'm sure you've all felt that way to some point, right? So that's not too crazy. We've all kind of gone through that emotional roller coaster. And then it says, not sure I'm cut out for all this crap. You've probably been through that too, right? So far you're like, well, geez, Jared, there's nothing insane about this. That sounds pretty normal. It's been nothing but losing tens of thousands of dollars. Well, the losing part is fine, right? New traders lose. And then it goes to tens of thousands of dollars since I started. this crap. You're only missing out on about a quarter inch of the slide, Josh. Literally, you're missing out on like a little sliver of the slide, like quarter inch. And I had a feeling the stock market was a BS scam from the very beginning. Should have trusted my instincts. So lost tens of thousands of dollars. Well, that's on you, man. $5, $10 risk. Ever heard of money management? Obviously not. You must have YOLO'd it. You must have Wall Street betted it. Maybe you GME'd it, but you stupided it too. Okay. The fact that people come into this thinking the market is a BS scam. What is that, guys? What do we call somebody like this? Well, it's a rhetorical question. We call somebody like this a victim. Victim mentality, okay? There's nothing BS about the market, right? The market just is, all right? You're not good or bad to the market. You don't exist to the market, okay? So the market can't be a scam if you don't even exist to it. So you're just clearly and obviously not prepared or didn't come in prepared. So don't blame the market. My point in saying this and putting this to the insanity is stop playing the victim. There is absolutely, unequivocally nothing positive to playing the role of a victim in any aspect of life, but particularly in the stock market, okay? You can't sit here and say, oh, well, it's because I don't have a college degree. Oh, it's because my boss doesn't like me. Oh, it's because I'm rich. Oh, it's because I'm poor. Oh, it's because I'm Asian. Oh, it's because I'm white. No, the market doesn't know you. You're just a number. You're not even a number to the market, okay? So stop playing the victim. It's just a joke. It's just absolutely ridiculous. The market is not a BS scam. It's probably second to real estate in terms of the greatest way people make money in the world, right? Probably second to real estate. They're pretty damn close, stock market and real estate. But yet it's a BS scam? Yeah, exactly, Alex. It's because I'm a moron. Now, this second one I thought was, well, pretty familiar for a lot of you. Honestly, that's the reason I put it on here. You sit here and you're like, wow, this looks very familiar to something you may or may not have done in the past, right? So this person buys a lot and they sell a lot. They buy a lot, 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 buy a lot. What are you doing? Oh, well, I'm getting a better cost average in my position. Are you? Is that what you're doing? So at what point are you going to stop buying those lots? You're just going to keep buying them until it goes down lower and lower and lower and lower? What if Microsoft went down to like 150? Well, you're going to hold a pretty heavy bag of lots of stock, right? I mean, 1, 2, 3, 4, 5, 6, 7 lots of stock. I don't know how many shares this represents or contracts or whatever this person's up to, but are you kidding me? So you took a trade, it goes against you, and then you add more position, and then it goes more. And add more, and then it goes more. And I'm going to add more, and then and I'm going to add more. I'm going to add. What are you doing? And then the coup de grace, the icing on the cake, the cherry on top, right at the bottom. You see the bottoming tail there, a scary rug pull. No way it's coming back today. Bounces just a tiny bit. Boom, out 6 lots. Lost $2.50 on this thing. However many shares that is. I don't really know how many shares that is, but it's kind of funny. And then what happens? Retest, bounce, rip. Fuck. Now, you got to admit, I am sure that many of you or several of you or more than that have been in this position in your life, right? You've done something you know is wrong. You're cost averaging down on a losing position, which is one of the dumbest things you can do in the world. And then you get out for a loss, and then it goes right back up. And you just want to throw that keyboard, throw that mouse, punch that monitor. The market's just laughing its ass off. And then you get to play the victim card, just like the last player of the insanity game. I'm a victim. No, you're not. You were an idiot. You're not a victim when you're an idiot. Being stupid is just being stupid. Don't make an excuse for being stupid. Just fix it. Okay? So losing to or adding to a losing trade is dumb. This isn't long-term investing. Like, this isn't where you add some money to your 401k or your IRA, or maybe you're saving money on the side, or maybe you're investing in VTI or VTSMX, whatever, and every month you add 500, 300, $1,000. That's different, right? That's a 20, 30, 40-year portfolio, and you're adding to the total market. This is a trade. You don't add to losing positions in a trade. This is just dumb. So this is why I look at it. I brought it because, is it crazy insane? No. But I bet you it's the type of insanity that many of you have done before, right? I bet you many of you have pulled this shit before, right? well, if I cost average lower, now all of a sudden I only need 20 cents to get back to even instead of 50 cents to get back to even. And it keeps going lower. And then you're bag holding. And then this bad trade turns into a really bad nightmare. Okay? Take the loss, check your ego in the closet, and just move on, man. Right? Move on. All right. The 4 pictures of power. All right? Trading with the trend. Before we get specifically into the 4 pictures of power, okay, you have to understand that there are 2 time frames that we generally look at in trading. I call it a time frame of bias and a time frame of entry. All right, so the bias time frame is the bigger picture time frame, right? This is saying, okay, what is the ultimate trend of this stock? Is it an uptrend, a downtrend, a sideways trend? But I need to know what that bias is because it's going to have a direct impact on the type of entry I'm able to get. Is this going to be a short play? Is this going to be a long play? Do I have to perfectly time this with the market? So that higher time frame, and for intraday traders, that higher time frame is the daily, the 60, and sometimes the 15. It's rarely the 15-minute, but it can be. If you're like a 1-minute trader, you could probably use the 15-minute as your time frame of bias. But you need a daily or a 60. And if the daily or the 60 is crap, guess what? The entry's going to be crap too. And I find this happens frequently with traders. I call it vacuum trading, where you're just looking at the 2-minute chart or the 5-minute chart and you're like, oh my gosh, that's the nicest 3-bar play I've ever seen. And then you look at the 60 or the daily and you're like, shit, that's why it didn't work. But at the time, you hadn't looked at the daily or the 60 and it stops out and you're vexed. You're like, why did this trade not work? And then later on, you're doing your homework after the market closes and you're like, I got it. I didn't look at the time frame of bias. So we have 2 time frames: bias time frame, entry time frame. Okay. Typically for intraday traders, the bias is daily 60-15. Typically for intraday traders, it's the 5-minute, 2-minute, or 1-minute. Some people will use a 3-minute or a 10-minute, but a lot of us use the 1-minute, 2-minute, and 5-minute. Okay. So once you figured that out, now we need to do what? We need to look for pictures of power on higher time frames. And these are the 4 main pictures of power. Okay. A wide range bar clearing significant support or resistance, extreme relative strength or weakness, a strong trend on a higher time frame, or gapping stocks. These are pretty much the 4 main things you're looking for. When you wake up and you get in front of your desk, it's 8:30, 8:45, 9 o'clock, whatever, and you're looking, what am I going to trade today? One of these or all of these or 3 of these 4 things needs to come up. It has to come up. You're either looking for that wide range bar clearing significant support or resistance. You're either looking for relative strength or weakness against the market. You're looking for that strong, perfect uptrend or that really weak downtrend, or you're looking for some form of gap. Those are the 4 things you look for. Okay, so what does that look like specifically? Well, I kind of put them in order here. A wide range bar, and this one's on a 60-minute chart, and I apologize for that. Not apologize, it's part of a picture of power, but there are 2 wide range bars here, right? Right here, you have a wide range bar taking out this resistance to the left, this pivot at 33.50, this pivot at 33.50, give or take, this red bar at $34, and then it chops around and goes higher again. But this is the type of bar you're looking for. Now, here's the rub. Sometimes these types of pictures of power will happen after the market opens and you're beginning to scan, right? Sometimes you'll find a stock that's close to breaking out on the daily chart and you'll be like, okay, well, this thing could put in a wide range bar today because it's close to breaking out, which not exactly the same thing, but it's a little bit of what we saw in EOG, right? One of the reasons it was so nice is it showed relative strength, which we're going to talk about, and it also was breaking out of a daily range. So we kind of had 2 of those 4 pictures of power, even though it didn't really put in a wide range bar. But anyway, this wide range bar is something you'll often find after the market opens when you're scanning at 9:45, 10 o'clock, 10:30. But in this case, your goal is to see this wide range bar break above the blue line and then find an alternative entry. Now, could you buy this as a swing trade as is? Yeah, you could. You could buy this thing right at 34.25, put your stop way down here at 32, right? You could. Entry at the blue line, stop way down here. You could. But that's a wide stop. Wouldn't it be beneficial potentially to maybe take a small lot there with a wide stop and then look to add back? And in this case, where would you have added back? You would have added back at 35 and you would have raised your stop under this bottoming tail. So you would have originally gotten in at say 34.25, with a wide stop, like a $2 stop, just over a $2 stop. Then you would have added at 35. So now you can raise your stop all the way up to, say, 33.50. Give it a little wiggle room, right? Under that 200 there, okay? Sorry, under the 20. My apologies, not a 200. All right? So all of a sudden now you have a cost average that's somewhere around, I don't know, 33.70, give or take, 33.60. 34.60. And your stop loss is 33.50. So what did you do? You took what was a $2 stop and turned it into a $1 stop loss. And boom, it triggers. Now you're already up 1R versus only being up half of an R previously, give or take. Okay, maybe 1.5, something like that. Okay, actually, you're not up 1R. You're up more than that because the cost average is like 34.60. So you're really up almost an R&a-half just because of the ad. So the 60-minute chart might be the most important time frame for intraday traders. The daily gets all the attention, but the 60-minute can help provide an inside look at the daily and provide you an entry that you might not have otherwise considered. All right. So a lot of people think, oh my gosh, the daily is everything. It's everything. And it is important. It is. But the 60-minute to an intraday trader might be the single most important time frame you have. All right. It's going to help you get into some of those daily buy setups a little bit sooner. All right. It's going to help you get into some of those daily breakouts perhaps a little bit sooner. So definitely keep an eye on the 60-minute chart. Now, this one was from, what was this, Monday, I think? We took a nice trade on Apple on Monday. So let's take a look at Apple, right? So this is relative strength, one of the second picture of power, right? So wide range green bar does what? Takes out this pivot at 132, takes out this pivot at 132.60. So when we look to the left, there's really nothing there. But notice, and this is important because most of you are aware, I mean, Apple is a heavy market-related stock, right? The correlation factor between Apple and the QQQ, the NASDAQ 100, is pretty high. It's pretty significant, okay? So when you look at first bar of the day, you're like, whoa, Apple's got a wide-range green bar, and the QQQ has a wide-range red bar. We immediately have a divergence, all right? We immediately have a divergence, okay? Wide-range green, wide-range red. That's a positive thing if you're looking to go long on Apple, okay? Then what happens? The Qs go down one more bar. That's a wide range bar. What does Apple do? Puts in a narrow range bar in the upper 50% of the first bar. So I have two bars here showing me, proving to me that Apple is much stronger than the QQQ. Well, look where the Qs are. Two red bars down into what do we have to the left here? Pivot support, pivot support, pivot support, pivot support, just a whole bunch of support down here. And Apple, wait a second. So Apple put in a wide range green bar clearing resistance while the Qs are pulling back and they're pulling back into support. This is money. This is straight money. You don't get trades more reliable than this. I'm not kidding. I'm not exaggerating this in any way, shape, or form. Whenever you see a FANG stock, whenever you see a Facebook or an Apple or a Google or whatever, okay? Do they still include Netflix in that? I don't know. Anyway, whenever you get a stock that's typically highly correlated to the QQQ, like a Microsoft or an Apple, and you see a huge divergence, the first thing you should look for is where's the next area of support in the market? Where's the next area the market's likely to bounce? Because the second that market bounces, it's going to be rocket fuel for Apple or Facebook or Microsoft or whatever. Okay? So if you look here, we're pulling back to support, extended a little bit into support. This is an area where the market should at least have a reaction, right? There should at least be some form of buyer stepping out. Now, will it rip like it did here? I don't know if it's going to rip, but there should at least be some support here. Soon as the market showed the tiniest, slightest little bit of green, what happens? Rocket fuel on Apple. Rocket fuel. Okay? We entered at 132.77. Our stop was 132.35. Made 1,300. Should have made about 1,700 on this. Oh, well. But the point is, this is what perfect relative strength looks like. This is what perfect relative strength looks like. Anytime you can find relative strength on a correlation stock to the market, like an Apple or Facebook, okay, and you get a 3-bar play, okay, you're going to have a really profitable trade. The reliability is probably 90%. I'm not exaggerating. It's why I spent so much time on this one slide, okay? The reliability is probably 90%, all right? Next, higher time frame power trend. Now, you're going, well, this isn't that much of a power trend, but it is, right? So once we had all this choppiness to the left, we pivot down here and we start moving up. You see the rising 200, you see the rising 20. It moves up, pulls back, moves up, retest, bounces again, and then pulls back 100%. So you could argue this is 2 in 1, right? You could argue this is a power trend on a higher time frame, and you can argue it's a gap. So we're mixing pictures of power on this one. Now, imagine if we did one more thing here. Imagine if we took a stock that was in an uptrend, that had a nice gap, and we included relative strength. We're starting to get more and more and more and more reliable. Isn't that what trading is about, guys? Whoops. Yeah, what just happened? Did I just lose my screen there? Uh-oh. Oh. There we go. Whew. That got a little scared. A little scary, okay? Whew. I'm back. All right. So isn't that what we're after? If we can get as many of these pictures of power to combine themselves in one spot, we continually get increased reliability. And that's what trading is all about. I'm trying to impart this in you. Like, for those of you who have taken professional trading strategies, right? It's like, well, why do we have the change of color bar? Why do we have a bottoming tail? Why do we have a volume increase? Reliability, reliability, reliability. Everything you can add to your trade to make it even a little bit more reliable makes you more money. So don't overlook your checklist. Many of you are just, here's my checklist. Yeah, I kind of use that sometimes. Really? Oh, well, every time I go to my checklist, the stock just triggers too fast and I miss it. Really? Well, then you need to either jump up a time frame like the 15-minute to give yourself more time, or you need to get better at going through your checklist. Because every time you skip items on your checklist, you're making yourself or your trade less reliable, not more reliable. Okay? So, gap up on this in a power trend. So despite intraday trading, daily charts and uptrends are very important and can have powerful moves that translate into big money, right? You just need to find the intraday entry, which we'll talk about here shortly. Don't worry, I'm going to combine and put it all together. So you can also, as it says on the bottom left, you can also use the 15-minute as your time frame, not if, but let's change that to of. There we go. Got to move this over. There, it's better. We can also use the 15-minute as your time frame of bias if you're trading 1 and 2 minute charts. So in this case, we're looking at a daily chart, all right, because, well, we're trading 5-minute, 15-minute charts, but every once in a while you can use the 15-minute, okay? So let's take a look at what that looks like. This is a 15-minute time frame. So there are times, guys, and trust me, we'll get to it. I know I'm going to leave you hanging here for a minute, but we will circle back to this chart. I promise you we'll circle back to this chart. So what I'm getting at is this is a power trend on a 15-minute time frame, right? This is an uptrend power trend on a 15-minute time frame. Well, what's our job? Find an entry. We could just flat trade the 15-minute, or we could drill down to a 1-minute or a 2-minute and find an entry. All right? So wide range bar, moves up a little, pull back, moves up a little, breaks out, pulls back, moves up, chops around, goes higher. My point is you can use this as a bias time frame if you're on a 1 or a 2-minute. Now, for newer traders, I really don't recommend you trade the 1-minute very much. I think it's a very aggressive time frame. I don't think it's conducive to success for new traders. Okay, so stay away from the 1-minute if you're brand new. New traders should also probably stay away from trading the first 10 minutes, 15 minutes of the day. I know that that's tough, watching other people take trades and sometimes making money, and you're tempted to do it, but it'll cause you more pain than good. All right, next, gapping stocks. Now, is this the world's greatest gapper? No, not really, but you get the point here. It doesn't have to be perfect. Just make sure there's enough void to get your 2-to-1 or 3-to-1 reward to risk. Look to the left for any junk, right? Beyonce knows it. To the left, right? She knows it. Why don't you? So if you look here, you have what? A stock that's gapping over a red bar and just about over this pivot right there. Okay? So red bar here, pivot right there. And again, you can see the body of the bar right there. That's the opening, right? The tip of my cursor, the body of the bar is the open. Okay? Let me see 1 second. All right. So the body of the bar is the open. But note, there's not a ton of room here. There might be $1, $1.50, but that's okay. It's a $30 stock. This isn't like Amazon where having $1.50 worth of room is junk. It's a $30 stock, okay? So now you have your gap. Now what do we have to do? We have to drill down and look for an entry. But remember, you're just seeing the gap. You're not seeing the market. What if the market was gapping down and your stock's gapping up? now you also have two things. Now you have relative strength and you have a gap. Well, that's good. The more of these pictures of power you can combine, the more reliable your trading is going to be. So let's take a look at the entry time frames for the pictures of power. Okay, so we know the 4 pictures of power. All right, now it's time to figure out, well, how do we take advantage of these pictures of power? It's nice to see a picture of power, but they don't always give us an entry. Sometimes we'll see a stock and it'll just rip off the open. And you're like, shoot, nothing I could have done there, right? There's nothing I could have done there. All right. So what do we have here? Well, we have a wide range bar taking out a daily pivot. And why did I put this in here? There's a little sneak attack, right? Because it's a daily chart, which means you don't just have to intraday trade pictures of power. You can swing trade pictures of power too. If you see a daily 3-bar play like Roku here, wide bar, narrow bar, granted, I will wait for the blue line here just under 170. I'll wait for it to pass above this topping tail. And I'll still use this area right here. You're going to have, I don't know, a $10 stop loss on this thing. I mean, you're going to get in at like 169. Your stop loss is going to be like 157, $12 stop loss. Okay, but you can see the stock moves quite a bit. In a 6-7 day period, it went from 110 to 160. So this is still a picture of power with an entry. It's a little bit of a sneak curveball, right? It's a picture of power with an entry. We didn't have to drill down necessarily to get an entry on Roku here, okay? Now, relative strength. What about this? We saw the Apple trade, right? I showed you that earlier, which was a pretty good one. But take a look, and this is on a 1-minute chart, but take a look at the market. All right? You have the market over here just getting hammered, right? Chop, 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 lower, 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 lower. What's this stock doing while the market's getting hammered? Well, the initial move is lower, right? The first 4 minutes a day, these are 1-minute charts. The first 4 minutes a day, the stock goes lower, and you're like, okay, there might not be much to this because it's actually showing a little bit of weakness to the market. But after that 4 minutes, this stock does what? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 bars in a row, goes higher. And the market does what? Bounces shallow and then goes lower. Right here in the pink line indicates roughly the same time, right? The market's putting in a little bottoming tail near some support, and this stock's putting in wide range bars. Think about that for a second. The market is going lower here. The stock you're looking at is putting in a wide range bar. So what are you thinking? I'm thinking, the next time the market bounces, I need to find a way into this stock. I have to. I just have to get in it. Because if you have this kind of strength to the tune where the market's really pulling back significantly and this stock's going higher, find an entry. Well, in this case, you were fortunate because it gave you what would have been a 4-bar entry, but then it's just started pulling back in a narrow range and a narrow range and a narrow range. And then what happens? Right around 950, maybe 953, it rips. Guys, what happened right around 950 to 953? What happened? The market bottomed out. Right? So when you start to see the green bar in the market, this stock rips. Now, the challenge here was that the market was below the moving average. So the possibility is it bounces to the moving average and then drops. So then you have to ask yourself, well, what if the market bounced and my stock bounced and the market pulled back? What would happen to my stock? Would it also pull back? Maybe. But here's the beauty. The only thing that's really going to cause you significant trouble, okay? The only thing that's going to cause you significant trouble in a situation like this is what? When the market completely and utterly shits the bed. Does that make sense? Meaning, if you look at the market as... If you look at the market, okay, as 5 possibilities, all right? And those 5 possibilities are extreme strength, kind of a normal up day, average sideways day, small down day, and getting hammered. If you have a stock showing this level of relative strength, there's really only one scenario in which you're going to get hosed. And that scenario is extreme weakness. So we've already seen the market pulling lower here, pushing back, and the stock's already going higher. So the only way this trade doesn't work, the only way it doesn't work, is if the market gets thrashed on, like just killed. I think that's a pretty good bet, don't you? Already showing strength, giving me a pattern, market's bouncing. Only way I get hosed here is if the market just just shits the bed and dies. I'll take that chance. That's worth the risk. The odds are in your favor, okay? Another example. Now, remember, this is twofold. This is a stock that was in a higher time frame uptrend, and it had a gap. So we combined two with this picture of power. Higher time frame uptrend and a gap. What do we get? The gap up, okay? Decent size, but not crazy. It's like a $1.50 gap. What do we get right here? A big bar off the open, and then a nice pullback, about a 50% pullback. You get a little doji bar, a little bottoming tail bar, narrow body bar, change of color bar. You're getting in right here. Your stop's right there. Moving on up. Could you possibly add here? You could. And if you raise the stop, you might have gotten tagged right there. That's kind of the issue. Of course, you would not have known that. So if you did choose to add right here and put your stop under here, it looks like you may have gotten tagged. But if you took the original entry, you did all or nothing, you probably would have had a very successful trade, right? The first bar is exactly what you wanted to see. You get in right there, your stop's right there, boom, wide range bar. It's showing commitment from the buyers, chops around a little bit, but still grinds higher. I mean, ultimately, the stock went from roughly, 45.50 back up to 46.50 on what was probably 20-cent stop loss. I mean, this was money. Just the first bar alone, you probably would have made an R1.5 to 2R. Okay? So this, again, is how you take a higher time frame picture of power, and in this case, a gap as well, and drill down to a lower time frame and take a trade. This one is a 5-minute chart. That's the daily chart. Boom. That's matching your time frames. Using those pictures of power to make money. All right? This is another example, but a unique example. Higher time frame, lower time frame. Okay? So, for example, we always talk about the 60 and the daily. Well, in this case, we're going to focus on the 60. And I showed you this chart. I think it was a week or two ago. I showed you guys this chart. So you're familiar with it. Stock goes crazy. Climactic, really. I mean, it goes from 106 to 122. Huge volume spike. So you get this huge move, all right? And then it gaps up. And there's some resistance up here. Double, triple top resistance, right? Double top now. And then the stock looks extended. It looks tired. Now, what are we doing? We're using our higher time frame bias, in this case the 60, and we're drilling down to a lower time frame, in this case a 2-minute, and shorting it. Why? Because it's extremely extended into resistance with a topping tail, a volume spike, and it should pull back. Now, here's the key. Understand the expectation. You're not marrying this stock. This stock isn't going from 122 back down to 104. That's not the expectation here. The expectation is, how do we find 2 or 3R out of this thing, because it is so extended and it's going to pull back. But this is not a swing short. This is not a 15-minute all-day short play, although it ends up turning into that. That's not the expectation. I need you guys to understand this. That is not the expectation. The expectation here is hit and run. This is an extended stock. It's gotten a little ahead of itself. It's very strong, so we have to respect the strength. So we're not going to marry this thing and try to get down to $4 or get down to $100 on 102, 104. We're going to take our 2 or 3 and we're going to run. We have a 60-cent stop loss on this thing, and we're going to try to get $1.50 and be done. Well, in this case, it ends up going a lot more than that. It ends up going $5. But the expectation was hit and run, get 2 or 3R, move away. Why? Because it's so strong and it's probably going to pivot and bounce. But you did use the higher time frame to match up with a lower time frame to get your entry. Okay? Now, you got to solve this gap. All right, here's that stock that gapped. Remember, the tail of the bar was intraday. We know where it opened because of the body of the bar is where it opened. It opened almost above resistance. Okay? And this is a 2-day trade, right? So the first day it gaps up. The second day it continued higher. You can't see that here, right? So this stock moves higher, pulls back, and you get an entry. All right? But this was possible because of yesterday's gap. All right? This was possible because of yesterday's gap. All right, so in this particular slide, and again, I threw you another curveball here. You're actually not seeing today's move. You're seeing tomorrow's move. Yup, you're going, what are you talking about? What I'm saying is you're seeing today's gap right here. But the day after, which is tomorrow, this thing gapped up. Actually didn't gap up. It opened flat, relatively flat, and then it moved higher. Why am I telling you this? Why am I showing you this? Because every once in a while you'll get a gapper like this, and it won't give you an entry. Sometimes they won't. Most of the times they do, but sometimes they won't. Well, if it doesn't give you an entry, does that mean this stock is just garbage now? It's junk? You're going to take it off your list and never see it ever again? No. It might be awesome the next day. I mean, it just gapped over resistance, and now it has all this void above. Where this green arrow is, this is all void above. So why would you take it off your list? Earlier today, we talked about carryover lists. Well, this should be on your list tomorrow. And what happens? The next day, this stock gaps down slightly, not much, and then it rips, pulls right back to support, pulls right back to the rising moving average, gives you an entry here and a stop loss down here, and this thing just rips. But if you had taken it off your list, you wouldn't have traded it the next day because, well, you took it off your list. Why would you do that? Remember, I got to impart this in you guys. You're business owners. You own a small business, and that small business is trading. You want to do whatever you can, as often as you can, to make money. That's it. And if that means keeping some stocks on your list that in this case close the day very strong, and you're going to yourself, this could be a second day runner tomorrow. It could be a second day runner. Oh, in this case it was. And it made a lot of money. I mean, this thing moved up $1.20 on a pretty tight stop. Okay? Now, this is that higher trend, right? We talked about the uptrend on the daily chart, the uptrend on the 60-minute chart. Well, this is what it looks like when you dig down. So you start with the daily, but remember I said sometimes you can use the 15-minute as your bias? You can, right? You can use the 60 and drill down to the 15 and find an entry. That's cool. No problem. Use the 60 as your trend, as your bias, and then drill down to the 15 for your entry. No problem. You can also use the 15 as your bias and drill down to the 1 or the 2-minute to find your entry. Well, we do a little bit of both on this slide. There's a lot going on here. Okay, there's a lot going on here. So we'll start with the 15, which is right in the middle. Okay, gap up, pulls back. You get a buy setup right here. You're above the moving average. You're just above an area of support, and it rips, chops around, rips higher. That's the previous day. All right, that's because of the gap. All right, this is on the day in which it gaps. This, if you guys are paying attention, hold on for it, is this. All right, let's do it again. Is this. Is this. Is this. Okay, it's this. I'm doing it again so you guys see it, the difference. Got it? You got me? It all started with this daily chart. All right, this is very important. Please pay attention. It all started with this daily gap. And this daily gap on this day, on the gap day, gave you a 15-minute buy setup. On the gap day, it gave you a 15-minute buy setup, an opportunity to make money. But remember we talked about the carryover list? The follow through the next day? So that gap up did give you a 15-minute entry. But look what it provided the next day. Had a small gap down, rips. That's your 5-minute buy setup. See this 15-minute, almost 3-bar play that never quite triggered? Is actually the 5-minute buy setup. After that, stock moves higher, pulls back. That bottoming tail is another 15-minute buy setup, but inside that 15-minute buy setup, you get confirmation with a double bottom retest on the 2-minute. So now you're not just looking at the 15-minute bottoming tail. You're going, man, I could get a better entry here. Right? I could get a better entry because this doesn't actually trigger till the second green bar. I might be able to sneak in above the little red bar. Put my stop down here. Maybe you take a half lot here, you sneak in a little early on a half lot, and you add back when the 15-minute triggers. So now you're not only taking a trade 2 days in a row, right? The gap is day 1, and then the continuation move is day 2. You're getting 1 entry, 2 entries, and 3 entries on this stock in 2 days. So you took the early entry on the 5, and then you can add to it on the 15-minute, but you snuck in a little early on the 2-minute, and then you got full on the 15. I mean, there's so much money here, it's ridiculous. But where does it really start? It starts with the daily gap in this particular slide. So this is why it's so important to make sure you're starting with the higher time frame bias. You're drilling down to the lower time frame for entries, but Don't give up on your stocks. You know, we all do it from time to time. We all do it. You get into a trade, right? And it works or it doesn't work. Or you see a gapping stock and you're like, man, that thing ripped off the open. There's nothing to do with it today. Or maybe it tanks off the open. You're like, that thing's so weak. I can't trade that today. And then the next day, after your trading day is done, it's 11 o'clock and you're like, I'm packing it up for the day. You happen to be scanning some stuff and you're like, shit, what just happened? Oh, that was on my list yesterday. Why didn't I keep it on my list today? And that happens to be up huge today. So what I'm saying is a lot of these gaps, not a lot, but 50-50, they don't run the first day. They don't do what we want on day one. They do what we want on day two. Does that make sense? So don't take them off your list. You're a business owner. Treat it that way. Be responsible. Okay? You put it on your list for a reason, and there are times you might want to take it off your list because maybe the reason it was on your list is no longer valid. But check back the next day on that carryover list. It's very, very, very important. Okay? And don't do this. I always have to leave you with some sobering stuff. Don't do this. Don't be an idiot. All right? Don't do this. Okay? Why do I bring this up to you guys? Why do I do such things? Because these things get brought up to me. It's that simple. You guys think I'm an ass sometimes, but I bring these things up because they get brought up to me. People in the chat room will ask me, hey, Jared, what do you think about DG? And I just kind of scratch my head like, really? Seriously? Are you messing with me? No, they're serious when they ask these questions. Okay? So let's take a look. This stock is up, I don't know, 5,000 bars in a row. Sure, there's some red bars along the way, but it double bottomed down here at like 172 and ripped to 220. And it's like, yeah, it's extended into resistance. Extended picture of power into resistance. Pivot, pivot, resistance. Okay? Go run 2 marathons. Take like a 1-minute break. And then I say, hey, I need you to go do it again. How do you think that third one's going to go? Not so well. Well, this is what people are asking. And then on a 15-minute, they're like, Jared, what do you think of this? What do you think of this 15-minute 3-bar play on DG? You sit there and you're like, were you in that lecture, the 4 pictures of power? Do you remember that lecture we did? No, Jared, I was going to the bathroom when you did that, or I was getting some coffee when you did it, or I wasn't here this day because I'm too special to stick around for the lecture. I'm one of those people. Oh, okay, well then take it. You should take it. It looks really good. No, this is terrible. This is really bad trading. Okay? Because this is what happens when you do shit like that. That's what happened. Now, in fairness, this never actually triggered. Thankfully, for this person's sake, it never triggered. Okay? But this is what's supposed to happen. It peekaboos up after a huge monster move into double top resistance. I mean, the stock gained like what? 30-some% on this move up in 3-4 weeks? You're not taking that. And then that's the result you would expect. Now, again, it never triggered. But you wouldn't be looking at this. Come on. So don't do it. So it goes back to say, don't do this. All right? Just don't do it. All right? So, we'll end with this. If we did our job properly, with the picture of power first, that comes first, then we should be in a good position to take advantage of a significant move. We should. This does guarantee that we'll find a lower time frame. No, it doesn't guarantee it. But we're off to a good start, right? We're putting one foot in front of the other and we're moving in the right direction. These are all powerful concepts and when applied correctly should correlate to a high level of accuracy. Therefore, it's okay to be somewhat more aggressive with a good lower time frame entry, especially if you combine some of these pictures of power. If you can get 2 or 3 of these, for example, you get a stock that's got a great power trend on the daily. Then you get a stock that has a great gap within the power trend on the daily. Then you get a stock that has a great power trend with a gap within the power trend and relative strength to the market. Right? The heavens open up and your accuracy goes to 80 or 90%. Then you really want to find an entry. Get in early with a good pattern and look to add for maximum gains. That's it. Boom. Now, that's a lot easier said than done, but that comes with practice. All right? But I am telling you, these 4 pictures of power are extremely important. If you start Without these, you're dead in the water. You got a 20% chance of that trade working. And the question you want to ask yourself is, why would you want to take anything that has a crappy higher time frame anyway? Just ask yourself that question. Why in the world would you ever want to take anything that has a crappy time frame to begin with? Just remember, there are 3,000-4,000 stocks to pick from. Why that one? Is that the best you can find? And if it's the best you can find and it's still crap, don't take it. You can sit on hands, right? Yeah, that's true, right, Robert? In this market, things only go up. Oh, okay. So I hope you guys enjoyed learning a little bit about pictures of power, but not just pictures of power, how to take advantage of those pictures of power with a lower time frame entry. I hope you'll heed the advice that you were taught today, as well as don't take that last trade we looked at, okay? So I'm Jared Wesley of Live Traders. We will get back at it again next week.